mode.
Hello and welcome to today's Premium Account Market Update for December 2015. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offered presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hein, Managing Director of Investor Signals, and I have 17 years of experience in the financial services industry and a current licensed securities and derivatives advisor. The format for today, we look at the macro update driving equities. We roll through the ASX top 50 stocks with a particular focus on the earnings outlook and the technical trends, and conclude with the portfolio allocation and market outlook. The Investor Signals service is a model portfolio of ASX top 50 stocks. We utilise call options to enhance portfolio returns. We're focused on effective ownership around dividend dates, generating above average cash flow from call options while still looking for capital growth. It's all managed under a strict investment mandate, and importantly, the assets remain in your name. If you'd like to know more about the service, please contact me, Leon at investorsignals.com. Moving straight into a graph of the top 50, the graph's reflective of the downward pressure that we've seen on Australian equities, with the indexes off roughly 20% over the course of the last 6 months. Following the interest rate rise in the US, arguably sort of the monkey's off the back and maybe equity markets can at least stabilise, and the excessive sort of selling pressure in the Australian market that we've seen within the banking and resource space probably looks a little bit oversold now and starts to find a floor. So on that note, let's roll through the top 50 stocks and just have a look predominantly today at the technical patterns with some limited discussion around the fundamental data. AGL continues to trend higher with higher highs, higher lows. The company trades on about a 4.5% dividend yield, and looking a little bit expensive for us. We're buyers of it back at around $15.50 over the course of 2016. Amcor, we continue to like this name. It delivers about 6 to 8% earnings growth, trades on a dividend yield of about 4.2%. We've been aggressive selling the covered calls up at around $14.25, and that's boosting the cash flow up to in excess of 10% per annum for us. AMP, we're a little bit cautious here. We're certainly pleased to see the better earnings result over the last 12 months, but a bit of a question mark whether that 10% earnings forecast can be achieved in the next 12 months, so better opportunities elsewhere. One of those is certainly ANZ. We continue to like this name. We've traded it a couple of times over the past few months and successfully locked in these sort of 5% bounces. I think a base is now in place, and gradually over the next 2 to 3 months we see a sort of supportive structure develop, and maybe into the first quarter of next year we start to see a better backdrop for the Australian banking shares. ASX, we continue to like this asset on a 5% dividend yield and roughly 5% earnings growth. I think ASX is a reasonable place to have money parked over 2016. AZJ, this needs to go onto your watch list. At these levels, it's starting to look attractive. It's been sold off heavily on the back of sort of average, well, not much in the way of haulage tonnage growth over the last 3 to 4 months, and really we're seeing that reflected in very limited revenue growth for AZJ, potential for higher capital expenditure. All those things have weighed on the price, but ultimately this will be an oversold story here, and there'll be a bounce from these levels back up to around 525 in AZJ. BHP, in line with the view on the index, I think these names are now oversold, has the potential to rally back to $21 over the next 3 to 6 months. There's no chance that the company, well, I shouldn't say no, there's limited chance, I think, that the company keeps progressive dividend policy in place. We get through the February dividend unchanged, but I think the August dividend will be trimmed back significantly to reflect the underlying earnings of BHP. The market will probably see that as a reasonably favourable outcome. The market's really telling us at the moment that the company's not going to continue that dividend at its current level anyway. I think BHP's worth about $21, and at that level it's time to sell covered calls and drive the extra cash flow. Brambles, we like this name, 6% to 8% earnings growth, but it's expensive here. Like Amcor, need to be selling covered calls over it to complement the income. CBA, so we've seen these negative structures across the whole market, and I've been focusing on those over the last couple of months of recordings, and I'm still quite cautious of how these structures ultimately play out. But I think the underlying fundamentals, just given the valuation or the sell-off that we've seen in the Australian market, probably starts to look a little bit more supportive now. So where we've been very cautious in portfolios, we've been holding about 20 to 30% cash. We've been very aggressive with selling the covered calls. That kind of thinking, I think, starts to ease back a little bit at the moment, and we start to look around for more upside opportunities. Coca-Cola, I think it can trade back up to around 9.50. Don't see it doing too much more than that. The stock trades on a dividend yield of around 5%. I think maybe we look for 5% earnings growth and a gradual slow trajectory of earnings pick up over the next 2 to 3 years out of Coca-Cola. So interesting one to keep on the radar. Computershare, I think the stock's expensive here and need to be selling covered calls over it. CSL, name continues to do very well, 10% earnings growth. The company's buying back shares aggressively. We owned it at lower levels. We'd taken profit at somewhere probably around $96 thereabouts. A little bit frustrating that it's kicked on further, and we kind of reassess whether this is one that we jump back into or not. I suspect it could trade maybe up to 105 thereabouts. So look, it's on the radar again and continuing to reassess what we want to do there. And then through to GPT, this is one of our main property stock exposures. I think it's getting expensive here at around 470. And to the extent that we still own it, we've sold the covered calls over it. Within the property play, probably at the moment, I think GPT's been our main area of exposure, and I think maybe Stockland now becomes sort of our more favoured overweight position within the property play. IAG, we've been aggressive with selling the covered calls here, driving the cash flow up to 10% per annum. We've seen insurance margins across the board, whether it be Suncorp, IAG or QBE, all under a little bit of pressure at the moment. IPL, we own this at lower levels. We've taken profit, keeping it on the radar, but the technical structure looks a little bit negative, and pressure could be to the downside there short term for IPL. James Hardie, the stock just got very expensive, in excess of 20 times earnings. We've seen this pullback. I think it's a buying opportunity, albeit counter trend. I think it trades back to around $18. Lendlease, I think this is one of the great value opportunities in the market. Continues to look for it to trade up to around $14.50. At that level, I think the stock can deliver maybe around 10% earnings growth, puts it on a 4.5% dividend yield. I see that sort of back to fair value at $14.50. Medibank Private, this is good value down here. This is worth putting on your watch list. I think it's a buy here at $2.10. Look for it to trade up to around $2.30. We've been aggressive with the covered calls over Medibank. So when you combine the income from the covered calls and the dividends, we're getting over 10%. Those calls wind off today at the 240 level. As the stock rallies back to around 225, 230, we'll reset those again into the middle of the year. NAB, further upside, as with my comments generally on the Australian banks, they're rebasing. NAB can trade up to $31. We're seeing them proceed with the spin-off of the Clydesdale UK banking division, which should allow them to focus more on their domestic business here and continue to grow what has historically been their strength in their business banking division, which I think the market will view favourably, and we should see the share price rise in NAB and the dividend yield therefore normalise with the other banks. So to put that in perspective, NAB currently trades on a dividend yield about roughly 1%, or between 0.5% and 1% higher than the other three majors. So I think in that environment, NAB could trade back up to around $31. And it's worth sort of keeping on the watch list. Newcrest continues to remain under pressure, albeit it's had a little rally from its lows, but nothing sort of really overly compelling there right at the moment. These oil and gas names remain under pressure to the extent that we can drive cash flow through covered calls. We are, but really not looking for a recovery in these energy space until sort of probably April, June, so that second quarter of next year. I reckon not doing it there. The price remains under pressure. Oil Search, we've seen the stock fall away following Woodside step away from their takeover offer. I think fair price for Oil Search is back up to around $7.50. Gradually expect that to recover over the next 3 months. QBE, insurance margins falling from sort of double digits down to around 8 to 9% have weighed on the price. Net, the interest rate increase in the US should be supportive for QBE, and we think it has the capacity to trade up to around $13, but at that point we want to be selling covered calls over it. Ramsay Healthcare continues to perform well. Rio, I think within the resource space, this starts to look more and more compelling, and I think a rebalancing across resource portfolios to ensure that at least equal to slightly overweight Rio relative to the other resource names makes sense in the market at the moment. Seek, this is on the radar. From our point of view, the technical structure's been negative. We're just seeing it break higher today. We are cautious that the company missed its earnings guidance at the half-year results, and I think we'll be sort of looking at the numbers coming out in January, February very closely with Seek to see whether we're seeing an underlying improvement there. Stocklands, I think this looks good coming into the December dividend. The stock trades on about a 6% yield. I still think that sort of the housing market, it probably remains an area of growth. So these names are certainly worth having a look at, and as I mentioned earlier, Stockland's probably our preference over GPT right at the moment. Sonic Health, we've seen this sell-off on the back of the change to the government Medicare support for pathology, which will impact Sonic's earnings. Maybe the market's had a slight overreaction. There's no guarantee that that policy change actually gets through. So I think down here at around $17.50, it's probably okay value. We own it at around $18, but we've been aggressive with the covered calls, and we're certainly comfortable with an outcome where Sonic largely trades sideways over the next 6 months, because a combination of the call option and the dividend, again, generating about 10% cash flow. Santos, again, throw a blanket across these oil and gas names, and I think sort of from April to June you start to see more substantial recovery in these names. Suncorp, under pressure in the insurance space. The banking division continues to actually do quite well, delivering about 10% underlying earnings growth, which was above trend or above average compared to the other banks actually, but the insurance business, we've seen downgrades to the earnings forecast there. But again, we've been very aggressive with the covered calls. We own it at sort of close to the current levels, but through being aggressive with the covered calls, they're pushing that cash flow again up to around 10%. I think Suncorp's a name that over the next 6 months we largely see it trading sideways. I think its range is probably $11.50 back up to about $13. Sydney Airport's a buying opportunity here at around $6. Transurban, a buying opportunity here at around $10 coming into the December dividend. We own this and we're selling the covered calls over it. I think that continues to make sense in this market. I think Telstra is good value down here at around $5.30. For cash that's available, I think it's worth continuing to expand the exposure to Telstra. Westpac, in line with the view on the other banks, I think Westpac can push a little bit higher. We have the covered calls up at around this sort of $33 level, and I think that probably captures the upside short term, $33 to $34 in Westpac. Wesfarmers at around sort of $40 to $42, I think, becomes a range for Wesfarmers over the next 6 months. That puts the stock on about a 5% dividend yield, but I think sort of this sell-off's probably overdone now, and as a minimum the stock either trades sideways or gradually starts to push up to that higher band there. Westfield is a great buying opportunity on the dip down here at around $9.40. I think at around $10 the stock's getting close to full value. We had the covered calls wind off anywhere from around this sort of $10 level in December, and we look to reset that call out onto the other side of the February dividend, which will start to sort of look at those opportunities to reset the calls in the early part of next week. Woolworths, the rallies have been short-lived here in Woolworths, but I still maintain that there's underlying value. We've been pretty aggressive with selling the covered calls to enhance the cash flow, but I think 2016 is a year of recovery for Woolworths. The stock's overdone on the downside. Woodside Petroleum, in line with the other oil and gas names, we see this sort of gradually recovering in 2016, but certainly the pressure short term sort of caps, I think, the upside. And there we are back to the index. So our general view of the market is this 20% correction now is starting to display some value. We're very mindful that we're in mostly sort of counter trend trades, which are always dangerous. So the structure is still to the downside. But the question really is, in light of the interest rate rise coming through from the US, the market having a stable reaction to it, slightly better data coming through from Europe, the early stages of a pickup of the first positive manufacturing data we've seen out of China for probably 12 months or so. Are we at a point where the market is actually forming a base move sideways? And I think probably on balance, there's every chance that that's the most probable scenario. So I think we still remain aggressive with selling covered calls, albeit across the portfolio we start to be very selective as to which names we think will outperform, and in those cases we try to hold back from selling the covered calls. But on average, the strategy of shifting to some cash and selling the covered calls have really helped to limit the downside damage in equity portfolios, considering the market's down 20%. And now it just becomes a strategic issue of trying to add value through the covered calls and be very selective in those names that we allow the upside, which I started to point some of those out as we went through today's recording. Thank you for listening in. I wish everyone a Merry Christmas. Enjoy the celebrations and time with your friends and family, and I look forward to speaking again in January 2016.